these central bank leases have terms on them. They've got to end these contracts so that the gold is not rehypothecated. It'll be very interesting to see when an audit finally does happen, and if we are headed toward any type of gold standard, anything related to gold, because the world's central banks, especially in the Eastern Hemisphere, they are collecting gold at a frantic rate, and it shows that the world's central banks think that something is up. And so we may be headed toward, and the fact that gold just overtook the euro as the second largest central bank reserve, and this just says to me that we could be headed toward something where gold is involved in the future when this monetary reset happens, that there is a transition coming.
Many central banks are allowing gold lease contracts to expire to prevent rehypothecation and secure ownership of physical bullion, and are rapidly accumulating physical gold. This behavior suggests they anticipate a significant shift in the monetary system. Gold now represents around 20% of total central bank reserves, overtaking the euro as the world's second-largest reserve asset. Gold will likely play a significant role in a coming monetary reset or transition. Physical gold liquidity will tighten as lease contracts end and less bullion is available for rehypothecation. Global central banks purchased a net 20 tons in May, based on reported data, which is close to but still below the 12-month average of 27 tons. Mike Maloney, an author, investor, and founder of goldsilver.com, emphasizes that currently, gold is sitting right on that long-term trend. Fresh tensions in the Middle East may have reinforced the strategic appeal of gold for central banks looking to safeguard reserves against geopolitical shocks. This continued interest in gold was also highlighted in our recently released Central Bank Gold Reserve Survey 2025. Gold remains a focus for central banks worldwide, with 95% of respondents expecting official gold reserves to continue increasing, up from 81% last year. A record 43% of central bankers also indicated that their gold reserves would rise over the next 12 months. Central banks worldwide added a net 12 tons of gold to their reserves in April, albeit at a slower rate of accumulation than in previous months. Global central banks are on pace to purchase 1,000 metric tons of gold in 2025, marking the fourth consecutive year of substantial buying. Central banks averaged a rate of accumulation of 400 to 500 metric tons in the previous decade, marking a significant increase of investment. Several African central banks, including those of Namibia, Rwanda, Uganda, and Madagascar, have recently announced plans to either initiate or expand their gold reserves. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
This is where we plugged in daily data in January of 1980 when gold peaked, but it's the daily close. It's not 873, the intraday, it's 850. So, okay.
Exactly.
And that shows that we are right on the trend line right now. And, if you think this is going to determine if you think then that gold is overvalued compared to the size of the currency supply, then you really should be selling your gold and moving into US dollars. What you see in 1980 is that one of the things that log does for us is every inch on this graph, or every, whatever measurement you're going to take, half inch if you're looking on your cell phone, quarter inch, or on a big computer screen, 2 inches, there's that big difference. If you've got to look absolutely vertically from the peak in 1980 to the distance to the green line, and then take a look at the difference in the distance in them today at the end of the graph by comparison. Minuscule. Gold is nowhere near as overvalued. According to the chart, they are actually very close now. The size of the bubble that gold went into, the percentage of global financial assets that it was in 1980 is very, very different. Today, nobody really owns gold. It's not a huge percentage of financial assets. assets. It's very small. And so I know we're not comparing it to financial assets right now. We're comparing it to the units of currency that exist. But what this shows you is that because others were drawn in a linear scale instead of logarithmic, where you're not seeing the percent change, you're seeing the amount change. That sort of fools us a little bit. You're seeing the actual percentage change. So every inch on this graph is the same percentage change as the previous inch. Where on a linear graph, okay, keep on going. I'd like to point something out. If you look after August 15th, 1971, when the first big peak there, and then it drops down and we get let me see what was happening. That was the gold rising, and then gold fell and created. So we're looking at gold basically upside down here. Gold was going up in price, causing the line to fall, and then gold peaked in the last day of 74, and then from first day of 1975 until I believe August of 76, gold fell by half. It had gotten up to $200, and it fell down to 103 in August or September of 1976. And so that causes that peak. Then it went all the way down to the bottom of that trough, January 1980, and then it goes up again, and it's not gold going up. This is gold falling. And then gold does a dead cat bounce and rises again and then falls, and you have an inverse head and shoulders pattern. And if you drew a neckline, which is a trend line, a neckline across those two peaks, you flip it upside down, and it's predicting a move going rising, and it way exceeded that. Now, that was predicting that gold would fall and the dollar would rise. Take a look at what we've got going on today. We have another slanted, not inverse, but a normal right side up head and shoulders pattern, and we've just broken the neckline. That trend line that you're drawing isn't just a trend line. It's a neckline on a tilted head and shoulders, which is predicting that this is once again, a linear graph. And so if this was logarithmic, what it would be predicting probably is a return to the balance, the type of balance that we had back before 1960. What would be the average before 1960? About 7, 8, 6?
7-ish.
Right. Do you see that? There's a right side up head and shoulders in this chart.
Yeah,
exactly. And so there's a lot of different ways of looking at this from a technical perspective. You can say, yes, it's broken a trend line. That would mean that either it's overvalued and you should get out of gold, or you should accumulate as much as possible because it's going to make this enormous move coming up right away because it just broke this head and shoulders.
Mike Maloney discusses using gold as a confirming indicator alongside stocks. They question whether gold should be sold if the dollar is expected to outperform, implying that a strong dollar would support a booming stock market. A recent survey by the World Gold Council, WGC, reveals that central banks globally anticipate an increase in gold holdings as a share of their reserves over the next 5 years, while expecting a decline in their U.S. dollar reserves. 73 central banks participated in the WGC's survey, conducted between February 25th and May 20th. Of those, 76% expect their gold holdings to increase over the next 5 years, up from 69% in last year's survey. Meanwhile, nearly 3/4 of respondents anticipate a decline in central banks' U.S. dollar-denominated reserves compared to 62% who held that view a year ago. The biggest move in precious metals, particularly gold, is still to come. Using a logarithmic chart, they emphasize that the gains from 2000 to 2011 were significant, but the current rise, which began about a year and a half ago, is just the start of something much larger. If a monetary reset is possible, gold isn't overvalued, the dollar is. Gold futures edged lower as a stronger dollar weighed on prices. Investors will be closely watching developments in the Middle East, particularly the risk of other countries being drawn into the conflict. President Trump cut short his trip to the G7 summit in Canada, citing escalating tensions in the Middle East, particularly over Iran's nuclear ambitions. Trump stated he wanted a real end to the nuclear dispute with Iran and warned that Iran cannot have a nuclear weapon. He also directed the National Security Council to convene in the White House Situation Room upon his return, signaling heightened urgency amid rising conflict between Israel and Iran. Investors will also be eyeing several central bank meetings this week, while the Fed is expected to hold rates steady. The Fed will also update its summary of economic projections, offering insights into the broader economic outlook and the future path of the bank's monetary policy. Markets are expecting a 25 basis points rate cut to come in September. Now, let's dive into the interview.
This is a great way of sort of throwing in a confirming indicator. Do you believe that you should get out of gold, that the dollar is going to outperform it? If the dollar does outperform it, we should have a great economy. Stock market will just continue on up into a bubble. There are so many ways of measuring the stock market, and there isn't one of them that you can find that doesn't say that it's in a gigantic bubble. And it's only PE ratios that show it being less than the greatest bubble in stock market history. There is no bigger bubble than what we've got going on, except when you measure it with PE ratios. Then it's like the second largest bubble in history that it's been in. But so there is a trend line. And if it's true that the trend line is the signal that suddenly one asset class is overvalued against another, or the currency undervalued against gold being overvalued because gold hit the trend line. Well, gold hit the trend line here against stocks. I think you've got another graph, don't you? From this one, what I see is that the biggest move in precious metals is yet to come. It's just started. Now, again, this is a logarithmic, and so percent change. And if you think the rise from the year 2000 to 2011 breathtaking, then you haven't seen anything yet. The rise that we've had over the past year and a half, just the beginning, something absolutely enormous. And so if you do think that there's the possibility of a monetary reset, you may want to be rethinking, is gold overvalued or not? The only conclusion I come up with is no. It's still the dollar that's overvalued. Do you think that there's a possibility that we could go into a recession right now? If you do, then they are going to be, if the Fed senses anything wrong in the economy, they've shown their hand. There's only two things that they can do: light up the printing presses and drop interest rates to zero to influence the banks to light up their printing press. Actually, I don't know what you would call a number duplicating machine. It's just a computer. You're typing in numbers. Bank credit. These central bank leases have terms on them. They've got to end these contracts so that the gold is not rehypothecated. It'll be very interesting to see when an audit finally does happen, and if we are headed toward any type of gold standard, anything related to gold, because the world's central banks, especially in the Eastern Hemisphere, they are collecting gold at a frantic rate, and it shows that the world's central banks think that something is up. And so we may be headed toward, and the fact that gold just overtook the euro as the second largest central bank reserve, and this just says to me that we could be headed toward something where gold is involved in the future when this monetary reset happens, that there is a transition coming, and it's natural. And we had one after in 1921 or 22, where the world went on a transition after World War I, different monetary system. Then it broke down at the end of the 30s, and after World War II, different monetary system. And then 1971, different monetary system. And they're very different monetary systems. The other ones they didn't affect the common man. They've affected any international businesses, and they affected countries and banks. The average person didn't even know they were happening. Comes to this transition, we're little baby steps off of gold. This one is going to be one huge step back onto something real, something that all of the different countries can trust each other, something that can't be created out of thin air. And if that happens, it's an enormous step that everybody on the planet will feel.
Global central banks, particularly in Africa and the Eastern Hemisphere, are increasing their stockpiles of physical gold while letting gold lease contracts expire, thereby lowering rehypothecation and tightening bullion supply. This behavior reflects growing concerns about the stability of the current monetary system and may indicate preparations for a monetary reset in which gold plays a central role. According to survey data from the World Gold Council, central banks' resolve to build gold holdings while reducing reliance on the US dollar has increased significantly. Meanwhile, geopolitical tensions and future central bank meetings continue to affect gold prices and market sentiment. As gold approaches long-term trend lines and broader macroeconomic concerns persist, many analysts believe the most significant move in precious metals may still be ahead. Could the expiration of central banks' gold lease contracts result in a scarcity of available physical gold for commercial markets? If gold were to take some of the dollar's global reserve status, how would this affect U.S. monetary policy and inflation in the coming years? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed.